Good morning, everyone. Thank you so much for joining us today. This is Penny Insurance, and we're so excited to bring you a webinar that will touch on how high-performing business owners are building buy-sell agreements to ensure continuity and control when the unexpected happens. So in this webinar, you'll learn how to choose the best agreement structure, fund agreements efficiently, and avoid common pitfalls that arise as partners age, retire, or pass away. So I'm really excited to introduce John McDonough, who is our partner in doing this webinar and subject matter expert. John, I'll pass the mic over to you.
Thank you. Appreciate that. And, let's get one thing straight right out of the gate. Most buy-sell agreements don't fail because they were drafted poorly. They fail because they were never engineered to work in real life. Today, we're going to talk about why buy-sell agreements break, what actually makes them enforceable, and how life insurance, when structured correctly, keeps succession plans alive instead of theoretical. And for those of you who I haven't yet met, I work with successful business owners, founders, and closely held companies. And my focus is in advanced life insurance and tax mitigation design for 8 and 9 figure estates, especially where business succession, liquidity, and family outcomes intersect. Last time on the podcast, we talked about, or the webinar, I should say, we talked about turning business success into enduring family wealth. And today we're focusing on something a little more basic, but also more dangerous when it's ignored. What happens when a business partner exits and there's no real funding plan in place? Every partnership ends, period. It ends by death, disability, retirement, or disagreement. And the issue isn't if, it's how prepared are you when it happens. And most agreements fail at execution, not intent. And when they fail, the cost isn't paid by lawyers, it's paid by family members, surviving partners, and sometimes by the business itself. A well funded agreement without funding, that's not a plan, that's a promise. And the chaos is optional. So here's what I see over and over again when it comes to buy sell agreements. Agreements are drafted once, put in a drawer, put in a filing cabinet, and forgotten. Valuations that don't often reflect reality anymore, funding assumptions that collapse under stress, no plan for timing, liquidity, or family expectations. This is where legal intent meets financial reality, and reality usually wins. When a partner exits without liquidity in place, bad things happen and they happen fast. Surviving partners are forced to borrow or sell assets. Spouses or heirs suddenly have a seat at the table that they never wanted. Disputes erupt over value, timing, and control. The problem isn't the death. The problem is death without liquidity. And there's three structures when it comes to buy sells. This isn't an opinion, it's mechanics. Cross purchase, entity, redemption, and the hybrid model. Structure determines who buys, funding determines whether it actually happens or not. In a cross purchase, the owners buy each other's interests in the business. This works best when there's fewer owners. Surviving partners get a step up in basis, which is a huge advantage. But the complexity of this cross purchase increases as ownership grows. More owners equals more policies equals more coordination. Still, though, when structured properly, this is often the cleanest solution that exists today. Here in entity redemption agreements, the company buys back the departing owner's interest. So administration, it is a definitely simpler than the cross purchase, but there's no basis step up for the remaining owners. And here's where cash flow planning matters a lot. And then there's the post Supreme Court Connolly ruling where this structure requires far more scrutiny than it ever used to. And we'll get back to the Connolly ruling here in a little bit. And then there's the hybrid structure. Hybrids combine the best and sometimes the least bad of both worlds. The hybrid structure allows flexibility around tax exposure, liquidity, and ownership transitions. For growing, evolving businesses, this is often where the real planning happens. And remember, structure sets the rules, but funding makes the rules enforceable. So let's be really blunt about this. An unfunded buy sell is a broken buy sell. Death of a partner creates an immediate obligation. Cash is required at exactly the wrong time. Loans and asset sales are reactive, not strategic. And this is exactly why life insurance works in this setting. Life insurance provides immediate liquidity at the exact trigger event, predictable funding, preservation of operations, and it keeps families out of the business. Life insurance doesn't replace planning, it makes the planning executable. Coverage, however, must track value. And what that means is there have to be regular valuation reviews, adjusting coverage as ownership percentages and ownership headcount changes, coordinating insurance design with the legal documents. If your insurance doesn't match your agreement, you don't have funding, you have exposure. And back to the Connolly decision, this is where lazy planning gets exposed. The Supreme Court ruled that entity-owned life insurance can increase the value of the business for estate tax purposes, which means higher company value, higher taxable estate, unintended consequences for the families. This didn't break buy sell planning, but what it did, it is exposed advisors who were not paying attention. And here's what it reinforces. Ownership matters. Structure matters. Entity-owned insurance can inflate the business value. Cross-purchase structures may help to avoid that issue. And coordination between legal, tax, and insurance advisors is no longer optional. Funding a buy sell isn't just about having insurance, it's about who owns it and how it's structured. So here's a case study. Two partners, equal ownership, cross purchase agreement in place. Each owner owns a policy on the other. Valuations are updated regularly. Coverage matches reality. And what's the outcome? A clean transition, step up in basis. Family gets liquidity, not a seat at the table they never wanted, and no increase in company value due to the entity-owned insurance per the Connolly ruling. That's how it's supposed to work. And what makes buy-sell actually work? One, the right structure. Two, proper ownership of the insurance. Three, funding that survives in real life situations. And four, ongoing review as the business evolves. If you don't know whether your agreement holds up in today's legal and tax environment, that's your signal. That's your next move. So here's a couple questions that I want to leave you with, and that'll close out the webinar for today. Ask yourself this. When was the last time you reviewed your buy-sell agreements? I would even ask the question, do you have buy-sell agreements in place? Who owns the insurance? And would your partner's family say that this plan is fair? Those answers tell you everything you need to know. And if you don't have the right answers to those questions, don't hesitate to reach out. Thanks for taking your time on the webinar today.